Good day everyone, especially to our beloved teacher. Good day ma'am. Today, our report focuses on cash management, a vital component of financial management that ensures organizational stability and prosperity. Again, cash management is crucial for businesses to stay financially stable, to meet obligations, and take advantages of opportunities. So this report explores the importance of strategies and effective cash management. So now let us proceed to the function of cash management that is concerned with determining the following. So first, the optimal size of a company's liquid asset balance, which is how much cash should a company keep on hand to meet its needs. Number two, the most efficient methods of controlling collection and disbursement of cash. So it is how can a company manage its cash inflows and outflows effectively. Third is the short-term investment. So it is what temporary investments should a company make with excess cash to earn returns. And the last is the types of float. When we say float, it refers to the time delay between a payments that it is made and when it is actually received. So we have two types of float, the collection float and disbursement float. So the collection float, it is delay in receiving payments from customers, while disbursement float, it is delay in making payments to suppliers or others. Cash management employs the use of cash budget that it helps companies plans and track the money coming in and going out disbursement over a certain period. So we have here the objective of cash management. So its objective is to balance having enough cash for bills and expenses while earning income from extra funds. Now let's proceed to the reasons why companies hold liquid asset balances. So the liquid assets is the assets that can be easily converted into cash without losing much value. For example, yung mga short-term investments, stocks, and etc. So first reason is transaction motive. So sa transaction motive, companies hold cash because their daily income and expense don't always match perfectly. So cash helps bridge the gap. Next reason is precautionary motive. So in this reason, unexpected requirements of cash sometimes can happen in the future. And since the ability to secure the funds needed is uncertain, liquid assets balances are necessary so as to maximize opportunities. So yun, a cash balance is held as a reserve for random unforeseen fluctuation in cash inflows and outflows. The speculative motive. So in this reason, companies hold cash to take advantage of future opportunities like buying something at a good price, ganyan. So the fourth is the compensating balance. So alam naman natin to, which is nag-hold ng minimum amount ng cash ang isang company in their bank accounts as a requirement for banking services or loans. So now let us proceed to the next reporter, Miss Esther Ninos.
Good day everyone, I am Quincy Westerninos and today I will discuss the cost associated with inadequate liquid asset balances or cash shortage. The first one is the foregone cash discount. So here, imagine a supplier offering a sweet discount if you pay your bill within 10 days. If you're strapped for cash or like you're short in cash, you might miss out on these savings, effectively paying more than you needed to. The second one is the deterioration of the company's credit rating. Consistently struggling to pay bills on time signals to credits that your company might be financially unstable. This can lead to a lower credit rating, making it harder and more expensive to borrow money in the future. The third one is higher interest rate. When your credit rating takes a hit, lenders view you as a riskier borrower. To compensate for this increased risk, they likely charge you higher interest rates on any loans you do manage to secure. The fourth one is the possible financial insolvency. In the worst case scenario, a persistent lack of liquid assets can lead to a inability to meet short-term obligations. If this continues, the company could face financial distress and ultimately insolvency, meaning it can't pay its debt and might have to shut down. The next topic is the determining the optimal cash needs may be derived using the following models. The first one is the cash budget. To explain this, think of a cash budget as a forecast of a company's expected cash inflows, the money that is coming in, and the cash outflows, the money that is going out, over a specific period like a month, quarter, or year. By projecting these movements, companies can anticipate potential cash surpluses or shortage. This allows them to proactively plan for borrowing if a deficit is expected, or for investing excess cash if a surplus is anticipated. For example, a bakery prepares a monthly cash budget. They estimate 5,000 in sales, cash inflow, and anticipate 3,500 in expenses, like for ingredients, rents, wages, and these are the outflows. The cash budget shows a net positive cash flow of 1,500 for a month. If, however, a major piece of equipment breaks down unexpectedly costing 4,000, the cash budget would immediately highlight a potential cash shortage of 2,500, prompting the bakery to explore short-term borrowing options. Second, the cash break-even chart. To explain this tool visually represents the point at which a company's cash inflows equals to its cash outflows over a specific period. It helps determine the minimum level of activity required to cover all cash expenditures like sales volume. Anything above this point generates positive cash flow, while anything below leads to a cash shortfall. For example, a printing shop has fixed monthly cash expenses of 10,000, which includes rent, salaries, or loan payments. Each printing job they complete brings in an average of 500 pesos in cash. Their cash break-even point would be 20 jobs per month, because the 10,000 is divided by the 500 per job. If they consistently complete fewer 20 jobs, they'll experience a cash shortage. The chart visually emphasizes the need to maintain a certain level of business activity to avoid cash flow problems. The third one is the optimal cash balance model, or the Baumol model for cash. This is a more sophisticated mathematical approach to determining the optimal cash balance. It balances the cost of holding too much cash, like opportunity cost minus the return you could have earned by investing it, against the cost of holding too little cash, which is the transaction costs minus expenses incurred when you need to convert securities to cash or borrow money. The formula aims to find the cash balance that minimizes these total costs. So as for the equation, the C, which represents the optimal cash balance, is equal to the square root of 2 times T. The T, which is the total amount of new cash needed for transactions during the period or a year, multiplied by F, which represents the fixed cost of making securities trade or of obtaining a loan, like per transactions, all divided by K. The K represents the opportunity cost of holding cash, equal to the rate of return foregone on market securities, or the cost of borrowings to hold cash. Here's an illustration. The company has estimated total cash requirement of 4 million over a 6-month period, with the payment steady over the period. The transaction cost of raising cash is estimated at 600 pesos per transactions. It is associated with the treasurer's time in making placement decisions, clerical, and other costs. The interest rate on money market securities is 24% per year or 12% for 6 months. Find the optimal cash balance. So the solution is C is equals to square root of 2 times 4 million times 600 over 0.12 is equals to 200. So the conclusion, the optimal cash balance is 200. The average cash balance is 100 because we will divide the 200 by 2. The company should make 20 transactions for 6 months, which is the 4 million divided by 200,000. The treasurer should program his placements to obtain maturities of 200,000 every 9 days.
So, Assalamualaikum warahmatullahi wabarakatuh and good day everyone. So, I am Shirlyn S. Gumander and I'm going to talk about the cash management techniques. So, when we say cash management techniques, this helps businesses optimize their cash flow and liquidity, and these are the following: the cash flow synchronization, speeding up the check clearing process using float, and acceleration of receipts. So when we say cash flow synchronization, this involves aligning cash inflows with outflows to minimize the need for large cash reserves. By synchronizing cash flows, businesses can reduce their transactions balances and optimize their cash management. Second, speeding up the check clearing process. So, this technique aims to accelerate the conversion of checks into cash. By speeding up the check clearing process, businesses can access funds sooner, improving their cash flow and liquidity. The third one is using float. Float refers to the difference between a company's checkbook balance and the bank's records. So, it has 3 types of float. The first one is mail or delivery float. The second is processing float and check clearing float. Ang mail or delivery float, this is it talks about the time it takes for checks to travel from the payer to the payee. The second one is processing float. So, ang processing float, it is the time it takes for the payee to process and deposit checks. And the third one is check clearing float. So, dito naman, the time it takes for the bank to clear the check and transfer funds. So, fourth, the acceleration of receipts. So, this technique involves speeding up the collection of payments from customers. So, the method include lockbox system and payment by wire or automatic debit. Ang lockbox system, it is a post office box where customers send payments, which are the collected and the processed by the bank. The second one is the payment by wire or automatic debit. It is the electronic payment methods that transfer funds directly into the company's account. So, all in all, these techniques help businesses manage their cash flow more efficiently, reducing the need for excess cash reserves and improving their overall financial health. So that's all. Thank you.
Hello everyone, I am Nicole Ashley Gonzalez, and for my part, we're going to discuss about marketable securities. So, I'm pretty sure you guys all know what marketable securities is. That's why we're not going to dive deeper into it kasi may iba tayong reason on why we're talking about it right now. So, let's proceed. Ano nga ba ang marketable securities? So, marketable securities are investments that can be quickly sold or exchanged for cash. They provide a way to earn returns on excess cash while still having access to funds kapag kailangan. So, an example nito is yung treasury bills, commercial papers, and stocks. So, company invests in these securities because they are liquid and madali silang i-convert sa cash. So, when choosing marketable securities, meron tayong several or 4 factors na gina-consider dapat ng mga financial managers when it comes to choosing marketable securities. So, of course, number 1, the default risk. So, it is the risk that the issuer won't repay the investment. So, for example, if a company invests in a bond issued by a company with low credit rating, there's a higher risk of default. So, of course, ang gusto ng kumpanya is to ensure that they can get their money back kapag kailangan. So, that's why financial managers can invest or should invest in securities with high credit ratings such as government bonds or bonds issued by reputable companies and able for them to mitigate this risk. So, number 2, we have interest rate risk. So, interest rate risk is the risk that changes in interest rates will affect the securities value. So, yung mga pagbabago sa mga interest rate, they can highly impact the securities values and returns talaga. So, for example, if a company invests in a 10-year bond with a fixed interest rate of 4% and interest rate rise to 6%, of course, the value of the bond will surely decrease. That's why, para ma-mitigate yung risk, financial managers should invest in securities with short-term maturities such as treasury bills and floating interest rates. Next slide, we have taxability. Taxability refers to the tax treatment of the income earned from the securities. So, taxes can greatly impact the returns on investments din talaga. So, for example, yung mga municipal bonds, they are often tax-exempt, right? So, it makes them attractive to companies with high tax brackets. So, yung mga financial managers, kailangan nilang i-evaluate yung tax implications of different securities and consider tax-efficient options. And of course, lastly, yields. So, yields naman, it refers to the returns on investments including interest or dividends. So, of course, yung mga company, gusto nilang mag-earn or magka-return yung investment nila. Kasi yun na yung point, bakit sila nag-invest, right? Para makakuha sila ng return from that investment. So, for example, if a company invests in a stock that pays dividend yield of 5%, so they're expecting that they'll earn a return of 5% on their investment. So, para ma-evaluate yung yields, yung mga financial managers natin, they should consider the risk-return trade-off and evaluate the potential returns based on the security's characteristics. So, by considering those 4 risks, the financial managers can make informed decisions about marketable securities. And, of course, makakagawa sila ng portfolio na ma-meet yung kailangan ng company nila. And it's all about finding the right balance din talaga between risk and returns. So, that's it for my part. Thank you.
Obtaining short-term funds. So, there are 2 ways that businesses acquire short-term funds or money for less than a year. First is the spontaneous sources, and second is the negotiated or discretionary sources. Spontaneous sources, these are the funds that automatically available through regular business activities. And take note, there is no special application or negotiation is needed. So it consists of trade credit, or a supplier let you buy goods now and pay later, like for example 30 days. So this is essentially a short term from a supplier. Next is the accounts payable. So alam na natin that the money owed to suppliers for goods or services rendered. Accrued expenses expenses incurred but not yet paid, like salaries or utilities. Deferred income, money received but not yet earned, like for example, the advance payments from customers. Next is the negotiated or discretionary sources. So these funds or sources require the formal application or an approval processes. And this includes bank credits, or these are the short-term loans from banks. Commercial paper, this is a short-term unsecured promissory notes issued by large corporations. Receivables loans, borrowing money using outstanding invoices or accounts payable as collateral. Ganon din sa inventory loans, borrowing money using inventory as collateral. So there are two formulas for calculating the cost of short-term financing. First is the annual financing cost, or AFC, for interest-bearing, which is the interest is paid. The formula is AFC is equal to interest cost plus fees all over usable funds times 365 days divided by maturity days. The interest cost, ito yung amounts ng interest na kailangan natin bayaran for loans over the loan period. This is calculated based on the interest rate and the length of the loan. Tapos yung fees is any ongoing fees associated with the loan, like for example, yung origination fees and processing fees. Usable funds, these are the amount of money we actually receive from the loan after deducting any fees. So yung 365 days represents a year. Maturity days, the length of the loans in a days. So, ang formula na ito calculates the effective annual interest rate of loan, taking into account not only interest but also the fees. Next is the cost of foregoing cash discount, or annual financing cost, or AFC, for foregoing cash discounts. AFC is equal to percentage discount divided by 100% minus percent of discount times 365 days divided by the credit period minus discount period. So, ang percentage discount is the percentage offered by the supplier for early payment. Then yung 100% minus percent of discount represent the percentage of the invoice amount you paid after the discount. So, yung 365 days represents a year. Credit period, the total number of days you have to pay the invoice. So, next is the discount period. Ito naman yung number of days you have to pay to qualify for the discount. So, ang formula na ito calculates the annualized cost not taking the cash discount. It also tells us what percentage return on us would have earned if we had taken the discount and invested the saved money. So let's have the example. A company needs $50,000 for 60 days and takes out the loan with a 6% annual interest rate and a $200 origination fee. So, makuha natin ang interest cost by multiplying 50,000 sa 6%, then times 60 days divided by 365. Then makuha natin ang $493.15. Usable funds, simple lang, i-minus lang natin sa $50,000 yung origination fee, then we get $49,800. Maturity days is 60 days, nasabi na din. So, substitute lang natin sa formula, then we get 0.0716, or i-times lang natin 100%, then we get 7.16% approximately. So this means that the company is effectively paying an annual interest rate of about 7.16% of this loan. So sa annual financing cost for foregoing cash discounts naman, a supplier offers a 1% cash discount for paying within 10 days with a 30-day credit period for full payment. So, sa percentage discount, nabigay naman din ng 1%. Then, ang credit period is 30 days. Discount period na 10 days. Then, substitute lang natin sa formula. Then, we get 0.8 0.185, then times lang natin 100%, so we get 18.5% approximately. So this means that not taking the 1% discount costs the company approximately 8.5% annually. So if they could invest the money they save by taking the discount and earn more than 8.5% on the investment, so it would be beneficial to take the discount. Always calculate the FC for different financing options to see which one is most cost effective. While cost is important, we need to consider other factors like flexibility of the financing, the relationship with the lender, and the impact on our company's overall cash flows. It also mentioned on the learning material about the matching principle. So, a matching principle, this means that aligning the maturity for the length of the financing with the life of the asset being financed. Like for example, using short-term financing like trade credit, or short-term assets like inventory that will sold quickly is considered better than using long-term financing for these long-term needs. Long-term financing is better suited for long-term assets like buildings and equipments. In summary, cost of short-term financing encourages using funds appropriately, matching the financing term to the asset's life.